Mukul Kochhar is joining us right now, and he's a head of institutional sales India with Investec Capital Services Private Limited. You saw him when they launched their India securities operation recently. Mukul, good morning. Thanks for coming back. I mean, this is once again turning south pretty fast.
No. So, as we were just discussing before the show, it's a problem in the markets. There's a little bit of panic there, but I think it's more a problem of overvaluation of securities. I mean, folks have actually been grappling with the fact that, what looks optically like reasonable valuation. I mean, if you look at earnings, forward earnings, optically the valuation looks okay, but these earnings are essentially inflated. We've been seeing downgrades for the last 6 months. Nifty earnings, have been downgraded roughly 10%. There could be another 10% to FY17 down earnings. I mean, even despite these downgrades, Nifty is trading at roughly 14.5 times on FY17 earnings. If you take out energy and banking, which are typically low multiple stocks, the Nifty X these complex sectors is trading at roughly 17.5 times. So despite the downgrades over the last 6-7 months, market's not cheap. Given that there's inarguably bad news flow around the globe, you'll need better margin of safety for investors to start dipping in.
So you're saying that earnings downgrades will continue, and so current earnings aren't worth very much, and future earnings are always overestimated. That's the problem, right?
In this cycle, they are. If you remember what happened, honestly speaking, it's not just a problem in India. If you look at the US, margins have been expanding for some time. Analysts drew a line upwards. I mean, they looked at margin expansion going forward. India, which is closer to home, the same thing started, I guess, in 2014 when we had a new government. Stocks went up, estimates followed. People thought there'll be a quick recovery in the economy. These things don't really sort of pan out such way in reality. Earnings do take time to come. Investment cycles do take time to kick off. And that is some of the disappointment that is going to start playing through earnings downgrades now.
Yeah. So at this point, based on consensus earnings, 17 earnings, what is the market trading at?
Yeah, so it's 14.5 times on Nifty. If you take out energy and banking, it's 17 times. If I take out mining, it's going to be even higher.
So, I mean, people, when they say, well, 14.5 times is not very expensive, they're kind of still looking at, and by the way, 14.5 times on Nifty assumes earnings. What earnings growth for 17?
Yeah, that is the trick, right? So first of all, if I look at earnings growth, it's roughly 17 to 18%. Now remember that
14.5 times.
That's right, for Nifty, right? So you have to dissect this further, and I'll take just a minute to walk through that. Now, if you look at what we're going to achieve in FY16, it's going to be roughly 5 to 6%. If you see what we achieved last quarter, and I'm talking, Nifty was pretty bad because you had a couple of banks taking big write-offs. If you just take out the banks and energy also suffered from low oil prices. If you just take out these two, it's better to get comparisons. So clean companies without charges reported Nifty earnings of 4%. 4% growth.
Third quarter.
4% growth.
Okay. Yeah.
Overall, we are estimating Nifty of 7% growth. Now, just imagine going from 4% to 7% for the year when 9 months are out. That is going to be a challenge. I think it's going to be a downgrade for FY16 also somewhat. Then going from 7% in FY16 to roughly 19% in FY17. So imagine the pace of acceleration that is getting built in. Most likely that is going to disappoint, and earnings are going to be downgraded. So when we look at a multiple of 17, which I think is more relevant because I need to take out energy and banking because honestly these are low multiple sectors right now. So if I take these two sectors out, a multiple of 17 is not cheap. And then you face at least 10-15% downgrades. So on FY17, the market does look punchy and pricey.
Why? I mean, we've seen actually a couple of years of this business, earnings being projected higher, and the final earnings being far lower than what the actual expectation is. We actually had, a few graphics a few months back. I'm talking about years, not quarters. Now, of course, I mean, analysts by nature are bullish. I mean, and people like markets going up. But the point is, the business is also to try to accurately predict what is going to happen in the future. Isn't that the case? Why the over optimism?
No, it's
yeah, go on.
Yeah, no, you hit the nail on the head. I mean, it's probably one of the sort of problems. You can say it's a problem, or it's just psychology at play, where people do express optimism in the future, and that translates into better numbers. I think we as a community just need to do some better job at forecasting forward earnings. For instance, I mean, anybody taking a look today saying that 4% accelerating to 17% or 19% for the full year in FY17 is going to be a tough ask. A little bit, what happens also is that as stocks run up, folks play catch up, and one way of justifying high valuation is just to push up earnings. And when you just had the rally like that you had in FY14, everything got pushed up, and now things are normalizing. Not saying it's right, it's just the way it plays out.
Yeah. So according to you, what will earnings growth finally settle at for 17?
I mean, if you do well, an acceleration from 4% in 3Q to, let's say, 10%, that's if you're doing well.
10% for 17 over 16?
Yeah, that's what I think. I mean, and I'm actually taking out, I'm taking out the charges.
Yeah. Sorry, you're taking out what?
I'm taking out the banking sector where a lot of the charges were there, and I'm taking out the energy complex, which is very volatile, difficult to project earnings.
So compared to 18% for total Nifty earnings, there was a consensus expectation.
Yeah.
Taking out the bad stuff, you get to about 10%.
10-12%, yeah. I mean, otherwise, I mean, you're just anticipating. By the way, this is going to be higher than what you saw, and I mean, it's like FY15. If I tell you that we had flat earnings growth over FY14, I mean, in again X energy and banking, and then you have 0 to 4%. Sitting at that time in FY15, nobody would have said that you'd have flat earnings growth in FY15, and nobody would have said you'd see 4% earnings growth in FY16. But here we are. So by the way, the world can deliver surprises. You can actually get 19%, but very unlikely to see that kind of acceleration in a couple of quarters.
Yeah. Mukul, let's talk a little bit about banking, right? Which is, I mean, energy, of course, is a global thing, and prices have all crashed. So one waits for that to pick up, and little you can do there. But banking, what really you think is going on? Standard Chartered reported 2015 loss $980 million from India alone. They lent a lot of money to the SR group. It was well reported in media, etc. Last year. Is there any takeaway, first of all, from the Stancy numbers for corporate-heavy banks in India?
See, one takeaway which is probably being echoed by a couple of corporate banks in India as well, who are sort of even on the private side, is that heavy exposures to single groups or single companies is probably, I mean, I'm not sure how it works out outside of India, but probably not the norm or a good play in India. Because, when write-offs happen, recovery is also in question because the entire group is going through trouble. So that is one takeaway, I think, for the banking sector is diversify exposures, don't have large exposures to single groups. The second thing is, just proper due diligence. Now, SR has a checkered history. And then suddenly, I mean, and markets have a funny habit of forgetting history. And, I mean, and by the way, I can't second guess what prompted those decisions. I'm sure they're smart and sort of, people who did that. But once again, in hindsight, it does look that, sort of a deja vu where people made one mistake and the same mistake was made again.
Fair enough. For Indian banking, where do you stand now, both for the private sector and public sector? Take those two pieces one by one.
See, I mean, for banking today, I mean, if you talk today, it's a volatile situation where, and banking per se, visibility is always low. Banking tends to be a sector, a play on the economy. When you see GDP growth coming, banks typically work. When there's questionable times, banks suffer. But if you look at what's happening in India, and it's been playing out over the last 7-8 years as private banking has grown, there's a decent market share shift happening from the private banks, from the PSU banks to the private banks. Now, the PSU banks still constitute roughly 70% of advances in India. Not necessarily all advances will be picked up by private in this, because some are sectors where the private sector really doesn't want to play. I mean, like I met somebody in the private banking space recently, and they were like, I don't want to lend to textiles. So even if the PSU banks vacate that space, I may not be active there. But certainly, it'll Pricing, which was very fine for risk in the loans that were given out, will expand, reflecting risk better. And some of the private banks will just continue taking market share from PSU banks just because they don't have capital for growth. PSU banks already have high leverage. They'll probably face further write-downs. Equity will be sort of, further impaired. So growth capital for PSU banks will be that much less available. Now, if you look at some of the private banks, HDFC Bank, while it's down 10% today in line with the Nifty, it's still trading at roughly 2.9 times price to book. So raising capital at 2.9 times price to book is just accretive straight away. And if HDFC Bank opens a book tomorrow, it will be subscribed. So capital is available for some of these guys, whereas for PSU banks, capital is not available. So growth will be a challenge there. So you'll see market shifts play out over time in the private space versus PSU. So while today looks volatile, some of these banks, on the private side at least, should be looked as decent investments for the longer term.
So for PSUs, what is the solution? What is the recap likely going to look like?
See, what we see is, by the way,
I'm asking you to make a forecast, a prediction,
it's a very good question, and the answers are not that complicated because you're saying this. See, once again, the same story being played out year over year, and partly it's because these are government-owned banks, and a lot of times there's interference in the play of these banks, which this current government is trying to correct, which leads to the same situation recurring. While the whole can be managed. They can be recapitalized, but if nothing changes, the same thing will recur in the next cycle. So one thing is, in my opinion, the PSU bank sector just needs to shrink. It's a natural progression. 70% of advances is just not sustainable. It's just the government lending to economy, taxpayers' money putting at risk. So it just needs to sort of one, shrink. Secondly, there just need to be a fewer PSU banks out there that the government can manage. There's so many out there today, and risk comes out of nowhere. That it's just a difficult situation for the owner, which is essentially the government of India, to manage. So I think the sector should consolidate. There's been studies and papers by prior governments as well on this. They just need to act on that. So I mean, while recapitalization can be done today, longer term solution is to make them independent. The banking board being spoken about may be a good step in this direction. But honestly, there just need to be fewer PSU banks out there.
What, merger, etc.?
Yeah, merger and consolidation. It just needs to be a more manageable situation.
What about the recap itself, which is the urgent need? I think everyone is closely waiting for that in the budget, because the government before last budget said 25,000 crores last year, 25 this year. I mean, but 25,000 crores is like two PSU banks.
I agree. So not enough capital can be provided in the short term to sort of get the balance sheet healthy. There has to be some give way by the RBI in terms of leniency on regulation for these banks to earn their way out of this situation. So recap will never be the full solution because that much money is just not available in a single year. Secondly, if you look at it, a lot of these PSU banks were already at high leverage, and they're taking hit on assets on high leverage. So equity is getting wiped out pretty quickly. So there has to be some forbearance from the RBI on some of these assets for these PSU banks to just get by the day, earn their way out, and then some really serious systemic reforms so that we don't get into this situation again.
Does it look like these banks will get that forbearance from the RBI? Because, I mean, if anything, comments from the governor and other RBI officials points in the other direction. They seem to be thinking that, well, get all the dirt out, provide for it. That's the only way. I mean, this forbearance business, I don't think the RBI agrees with that point of view.
No, I totally agree with you. So forbearance should not be provided in recognizing NPAs. So because what had happened is, unless and until a bad asset comes out in the system, there was some bank always willing to lend because they would sort of say that okay, it's not really an NPA. So that cycle has to of what the RBI calls evergreening has to come to an end, and it's the role of the regulator to make sure that malpractices don't happen in the industry. So that is fine. What by forbearance I mean basically providing over time. Living with slightly higher risk, that is slightly higher leverage for some time. If there's a better solution out there, I'm sure they'll think of it. So, but the only thing is,
bad bank?
I don't know. Honestly, bad bank, what does it do, right? It leaves the current banks in place. It just takes the problem away. It doesn't punish the guilty. Whereas, how does it drive you to a solution? While the bad bank can be managed, I mean, it's a good solution. But how does it drive you to a solution where this doesn't happen again in the future? Where is the answer to
No,
that?
that it doesn't do, but it kind of provides some relief, right?
Yeah, so you know what the RBI
over
is
the next couple of years.
No, I agree. But
yeah.
what the RBI is trying to do is make sure that we come to a solution so that the system as a whole is healthy.
Yeah.
That's a very temporary patch fix and just allows you to live another day.
Yeah. Okay, let's just talk about the budget, Mukul. Very briefly, what are your expectations?
So, you know, a budget is very talked about in India, but unfortunately, if you look at it, and this is the central budget, by the way. I mean, one just small point I'd like to note is that the states today are spending almost an equal amount as the central government, and nobody talks about the state budget and the inefficiency there. Yeah. But the central budget gets debated ad nauseum. But having said that, one thing one needs to realize is the central government budget is only 9% of GDP. And honestly, the entire revenue coming in, 130% of that is spoken in terms of revenue expenditure. So where is the flexibility out here? So in terms of the actual budget document, if you look at the numbers, there is literally zero flexibility with the government to do much.
What about giving yourself flexibility?
Yeah, but even if you sort of, let's say, take down revenue expenditure by 5-10%, you can't really take it down in the current construct. You stop growing
I'm saying not taking down expenditure, but getting more, not revenue, but borrowing more. I mean, increasing the deficit.
Yeah, so you had a fiscal deficit path which was recommended to be going down. So just keeping it flat is a big sort of ask. So just keeping it at roughly 3.9% is a bit.
What about expanding it actually?
I don't know. Honestly speaking, I mean, you expanded by 0.2%. That's an extra 0.2% of investment to the economy.
Not incrementally. I think that we are way past that point. If you got to do it, you got to do it meaningfully so that it moves the needle, right?
Yeah, you know what happens is in the past. So this is a very interesting debate because in the past, no government globally has been a responsible steward of capital. So if you one remedy is private sector is not really pushing, so let the government tax and spend. But the government taxes spends well for the first 2 years, and then ministries expand. There's more revenue expenditure. Capex gets forgotten. Yeah. In a sense, I mean, governments nowhere in the world are efficient stewards of capital. So I would say let them just enable policy so that the private sector can do its job, can get capital, can invest in good projects. That is the right solution.
You think markets are going a lot lower?
And if you look at earnings, I'm saying earnings are going down. See, lot is so I'm not, first of all, I was on your show, I think last week, and I said, I think the probability of a major crisis is not that high.
Yes.
But if you look at the stock market, it's going to be driven by earnings. And I think earnings are going down further.
So markets are heading west.
Yeah, they should probably correct maybe 5-6% from here. I mean, it's tough to say anything about the markets, but yeah, I can say earnings are going to be down. Valuations are high, that would point to a low market.
Mukul, thanks very much. Good speaking with you, as always. Interesting chat. Thank you.